so let's start this, today's lecture. Any question on last week? I have a couple of things I forgot from last week's lecture. So one was, I guess perhaps I did not emphasize enough maybe the distinction between fintech and big tech. No? So basically, I don't know if we discussed this, but so I don't remember. But basically, big tech is a company that doesn't do financial service primarily. So it really exists normally as a big IT company. Okay, and then it may also enter in the market for financial services. Fintech normally is a technology-oriented company, normally starting small, or at least starting small, that normally tries to solve a specific problem related to financial services, maybe payments or maybe credit provision based on algorithms. So that is a bit the distinction. So big tech is a non-financial firms primarily which enters the financial services. Fintech starts as a financial service provider with a technology focus. I also forgot to include an important paper on big tech in finance, so we'll add it to the slides or last week's lecture. So that is a good paper you could read about, especially about big tech. So firms like Facebook, etc. But apart from this, any other questions on last week? Another important point. So next week I would like, if possible, to do the lecture online because I may be traveling. Is that okay for you? I mean, I guess you are native on these things, and so what I plan to do is I will send a message in this system, which I think you can see, and there will be a link, and there will be a Zoom link on which you can click. So I have to arrange it with the assistant, but that's how it will probably work. It's still not 100% sure because I'm still not 100% sure it will be out, but I would say 80% probability will be online. But so wait for, kind of try to check beforehand. So before coming here, check the message. Before coming physically here. Yeah. Okay. So let's then start today's lecture, which is more about like a taxonomy or classification of different digital currencies. So I thought it would be good to start with a bit of a, in discussing what things are and so on, have a bit of a look at history a little bit. And so I guess it's useful to start with 1973, which is the collapse of Bretton Woods. So the Bretton Woods system, which was prevailing since the end of World War II, was based on essentially a peg between the dollar and gold. So that the dollar was, the value of the dollar was related to gold, and other currencies, or currency other than the dollar, were pegged to the dollar. So it was a system essentially of fixed exchange rates vis-a-vis the dollar, where the dollar was itself pegged to gold. So the whole system was basically tied to gold. It was not a gold standard, so people were not actually using gold to transact, but it was a system where the value of currency was actually tied to the value of gold. Then this was abandoned, so it collapsed in 1973 because basically the peg between the dollar and gold collapsed, partly due to the Vietnam War and other reasons. And so this was the first time basically in history when countries, so major advanced countries, uses an entirely fiat money system. So there was no link to any commodity. It was a fiat system. And so at the beginning, so in the 70s, they didn't really know how to manage it. And so this led in the 70s to the so-called great inflation. This was also helped by oil price shocks. So in particular in 1973, there was also the Kippur War, I think, between Israel and Arab countries. So big increase in oil price. Actually happened twice, in 73 and 79. So in the 70s were a period of very high inflation. So here, this chart here shows basically inflation and growth in the United States. I mean, the United States is the biggest economy, but you can find similar pictures for almost all other major advanced countries. So the blue line is inflation. You see that basically there are two big peaks, in the early 70s and late 70s, and you can also see that inflation was also volatile. so it moved around a lot. Okay, and note that it was starting in a quite low level. So it was, in the 60s, inflation was pretty low and stable, but then in the 70s, was this explosion of inflation. Okay, so gradually, I think central banks learned how to manage a fiat system. So there was a big disinflation in the early 80s, you can see here. And then since basically the mid 80s, there is a period which everybody calls the Great Moderation. So this was a period, so basically goes from 85 to the global financial crisis, more or less. So you can see that both growth, so GDP growth and inflation were both stable, so together. No? So the orange line and the blue line are both low and stable. They're much more stable in particular. This is the concept of the Great Moderation. So here you find two episodes of deviation from that. And I guess you can easily guess which two these two are. No? So the first is the global financial crisis. So the global financial crisis led to sharp contraction of growth, and then even bigger shock, the COVID-19 coming here. No? So this is COVID-19. Okay, so now, as I already mentioned, perhaps in an earlier lecture, it's not clear whether these episodes are just one-off. So you can argue, okay, the Great Moderation didn't end with the global financial crisis, continued. You can see that after the global financial crisis, inflation and growth remain quite stable. So the volatility remains low. So I remember there was a discussion in those years saying, are we back to the Great Moderation, or has the global financial crisis represented a break, a structural break in the Great Moderation? And I think the jury is still out. We still don't know, but certainly the COVID-19 episode doesn't change that much, because this was a very peculiar shock. A pandemic only comes once in a century. A global pandemic only comes once in a century. So it's not really, doesn't show that this big volatility you see at the end of the sample doesn't in my view show that the Great Moderation is over, or doesn't say much about it. The other interesting discussion right now, you can see that the blue line is going up a lot. So that is inflation, of course, and as you probably know, I've read, we are experiencing a period of relatively high inflation, not seen since basically since the 80s. Okay, this is mainly to do with the price of commodities and energy, but also food now. So energy and food prices are going up a lot. So that's a bit the history of. So this is, you can see. So this is, if you judge basically the fiat money system. So that is a bit the performance of it. So you can say, so at the beginning there was a mismanagement. You can put it this way, but since the mid 80s, the system seems to be being well managed. It seems to work well, at least, with the exception of these two large shocks. In parallel to these developments, in the last, I would say, decade or a little bit more decade, there was a boom in cryptocurrencies. So Bitcoin was launched in 2009, and since 2009, and even more in the last 5 to 10 years, I would say, there was a big rise in cryptocurrencies. So this discussion whether central banks should be in control of money or not started really around 10 years ago. And then what is also important, and we'll talk about it next week, in 2019 Facebook launches the so-called Libra project. So Libra is a stable coin, it's not the cryptocurrency, but this account of jolted central banks into action. So this competition, potential competition from Libra, which was seen as a kind of a credible alternative to central bank controlled fiat money, also considering Facebook as a couple of billion of members. So this was a big shock in terms of the monetary system. And since then, I would say in the last 3-4 years, there was a boom in central bank work on central bank digital currency. Basically, central banks themselves started to consider introducing their own digital currency, partly in reaction to these cryptocurrencies. So it's like the Empire Strikes Back kind of thing. So, And so these some countries have been pioneers, in particular China, and also Sweden in Europe. They've been the first. They started even before the launch of the Libra project, but now basically all central banks in the major central banks in the world are working on CBDC. So it's been really become a universal. So things are moving fast now because, as you can see, for many years, for decades, there wasn't much change. Fiat money was in control, great moderation, but in the last, I would say, decade, there was a much more movement, much more interesting movement. Yeah, this would be my kind of quick take of the monetary history of the last 40 years. But do you have particular questions on particular episodes? I mean, you of course other recessions. So it's not that under the great moderation. It's not that there is no recession at all. But of course, the global financial crisis and COVID have been particularly large. Another famous period was the 90s. So there was a recession in the US in the early 90s, which actually costed the then president George Bush the election. And then this period in the mid to late 90s, you can see high and stable growth, and these were the so-called this was the Clinton years, and there was also a digital revolution. So the rise of IT and digital revolution. So this was the 90s, was the period of boom of the US economy. But that I think has to do more with the fact IT revolution in the US. It's not due to the central banks or monetary factors. Okay, so now we are at a particular moment, I think, in history, because now it's a bit of a combination, because we have this high inflation, coming out of COVID. We have geopolitical tension in the world, and we have with this competition between cryptocurrencies on the one hand, private sector led, and also the response of central banks through the work on CBDC. CBDC stands for Central Bank Digital Currency. So it's a particularly interesting moment. How do I go down here? Okay. Now, so here I adapted this table from a paper by Beck and Garrett, which I encourage you to read. So you can basically, the idea is that you can classify different possible money into basically 4 categories. So the first category is who is the issuer. So whose liability is a certain money, okay? The second category is form. So is it physical or digital or paper? The third category is access. So who can use it? Who can use the money? Who can transact using that monetary standard? So who can use it? And the fourth is the transfer system. So how does this particular form of money change hands? How can it be transferred from person A to person B? Okay, and you can classify different forms of money according to this criteria. So, for example, let's start with commodity money, so gold. Okay, so who is the issuer of gold? Nobody. So it's a physical. So commodities have no issuer. There is nobody's liability. The form is mainly physical, but it can also be digital, because you can have a certificate basically saying that you are an owner of gold. You don't need to actually own the bullion of gold. You can actually have a certificate telling you own the gold. The access is universal potentially, and everybody can hold gold. And the transfer system is mainly centralized, so mainly goes through financial intermediaries. It's not decentralized. Although, of course, at the individual level also you can exchange gold, but it's less common. Normally it goes through some kind of financial system. Cash. Everybody uses cash sooner or later. So who is the issuer? Is the central bank is the issuer, meaning that cash is the liability of the central bank. Okay, so appears in the liability side of the central bank balance sheet. So, for example, the euro is a liability of the euro system, so the system of central banks in Europe. What is the form is physical.
So the cash you can hold obviously in your hand. Access is universal, everybody can hold cash. And the transfer system is mainly decentralized, okay? So it's more from person to person. So I go to the shop and I give the cash to somebody. So the exchange is decentralized, okay? Bank deposits, still now the most important form of money. So we discussed that bank deposits are still the main form of money. So whose liability is that? Is the commercial banks. So is a liability of a commercial bank. Note that is legally, must be legally convertible into cash. So banks are obliged to convert your bank deposit into cash. So that's why they have cash dispensers. You can go to the bank and you have a right to convert your bank deposit into a banknote. Okay, so the banks are obliged to give you some cash dispenser. Okay, it's not obvious because not all forms of money foresee that. So that's an important aspect. Form is mainly digital. So now bank deposits now are all digital. So it's a form of digital money. Access is partly limited in a sense that not everybody can have a bank account. That we discussed last week. I think that there are over 2 billion people in the world without a bank account. So it's not necessarily the case that you can have a bank account. So don't take it for granted. Although of course many people have it, or I have several. And the transfer system is centralized. Okay, so so if I want to send you money through bank deposits, is normally it can be done only by two of us. It needs to be the bank needs to do it. So there is a system of interbank. There is an interbank market where this happens. Okay, but it cannot be done from person to person. So you need the bank or the banking system. So in this sense, it's centralized. So there are intermediaries managing the transfer system. Okay, stable coins. So stable coins we look at in more detail next week. But basically, so with stable coins, the issuer is a stable coin issuer. So there is somebody, in the case of Libra, could have been the Libra Association or Facebook. So somebody issues. So is somebody's liability. Okay. The form is digital. So these are, of course, again, digital currencies. The access may be partly limited again. So it's a little bit similar to bank deposits. But of course, it's not clear because we still don't have really. So stable coins are still a bit of a niche or kind of small phenomenon. So as we will discuss next week. So it's not clear whether there will be universal access. And the transfer system, again, is not clear. So the transfer system for stable coins right now is mainly decentralized. So stable coins are mainly traded on blockchains, so using decentralized finance. But it doesn't necessarily mean that it cannot be done in a centralized way. So this is still to be seen. But right now, I would say it's mostly decentralized. Okay, then we have proper crypto. So just to be sure, I don't put stable coins under the name of crypto, but some people do. So when you hear about crypto can be either kind of currency like Bitcoin, but also some people also include also stable coins. I prefer not to do because for me a big difference between the two is that in the case of stable coins there is a stable coin issuer. So the stable coin is somebody's liability. In the crypto case, there is no issuer. So for me, crypto means that there is no issuer. But again, so not everybody. So some people tend to put these two together and they call them both crypto. But it should be clear that the difference between Bitcoin and stable coins is that Bitcoin has no issuer. While stable coins, there is somebody has a liability. Okay. But I would say what really defines crypto is the absence of an issuer. So it's a digital asset without an issuer. The access is typically limited. I mean, you need to be able to access the blockchain. So not everybody can actually access crypto. You can access them maybe indirectly, but if you want to make transactions using crypto, you need to have at least a good computer, a good online connection, and etc. So it's quite limited. And the transfer system is always decentralized. Okay, so obviously this happens mainly on blockchains, on decentralized distributed ledger technology, and so forth. So the key, I would say, key defining feature of crypto is really the decentralized nature of transactions. It's really the raison d'etre of crypto. And so in the lecture in 2 weeks' time, we will focus on this category, in particular on Bitcoin. So I will explain what the blockchain is, why it was introduced, etc. And finally, so last but not least, I said the central banks reacted. So central banks started to consider issuing their own digital currency, CBDC. So whose liability would be that? It would be the central bank, so like cash. It would be exactly like cash, a liability of the central bank. It would be, unlike cash, it would be digital. The access would probably be universal. I mean, still to be seen, because most of these cases are still under study. And the transfer system for central bank digital currencies is still unclear. So it's still undecided whether these will be used in, for example, in distributed ledger technologies, or they will be distributed by financial intermediaries, even by banks. So my hunch is that it will be mostly centralized. So centralized in the meaning that there will be somebody running the system. It will be the banking system or some intermediaries. There might be some niche use in distributed ledger technologies, but that will probably not be the main use of a CBDC. I mean, my expectation is that the CBDC will look like a bank deposit a lot. So your experience as a consumer will probably be not that different from having a bank deposit. So it will be managed through financial intermediaries. And so it will very much look like a bank deposit. Although the key difference with a bank deposit is that in the case of CBDC, the central bank is the liability, is the issuer. In the case of bank deposit, it's the commercial banks. So if a commercial bank goes bankrupt, you lose the money in the case of bank deposits, but you don't lose the money in the case of CBDC, because the central bank can never go out of business, okay? Can never fail, can never go bankrupt. So that is a little bit but again, we will have also a lecture on CBDC, so we will go through these issues. But I think there are several taxonomies of cryptocurrencies, digital currency, but I found that this is the most straightforward, the most useful to have. I mean, you may find other classification, but I think this is particularly useful. Any question? Any of those? What is most important? You understand really what these characteristics are, no? And then you can even guess yourself, what the particular. I mean, some of you, I think, asked me about NFTs, so non-fungible tokens. So perhaps like we can try. So non-fungible tokens is basically for those of you who don't know it, is basically like a token that can be traded on a blockchain, for example, but which just identifies a unique good. For example, so if I have I don't know, this is typically, if I have a work of art. I mean, now there is also online art, so you can create art online. For example, you can make a painting which only exists online. Don't ask me who would buy this, but apparently there is a market for that. And so these non-fungible token defines that you have done this, and you have kind of copyright on this creation, basically, and you cannot transfer. So why you can transfer two different bitcoins? So there is no difference between two different bitcoins. It's like there is no difference between two cash banknotes. Okay, €1 and €1 you can exchange, but with non-fungible tokens you cannot exchange. They are uniquely identified. It can be transferred, so the property can be transferred to different people, but they are uniquely identified. So there is one NFT cannot be exchanged with another NFT. Okay, so they are non-fungible. So under this classification, so for example, who will be the issuer of a non-fungible token? So whose liability is that? Any idea? Yeah?
I would say in the first place it's not money.
It's not my very good point. Exactly, it's not money.
I mean, the basic idea of NFT was not to create a system to convert it to different people, but to have a system where you can basically protect your online property and sell that. So I think the basic idea was different
I agree. So I mean, to the extent that I know what NFT is, which I know I don't know much about it, but I would agree. Actually, I forgot to say exactly that for me, being non-fungible and not non-universal is not really a form of money. Is another. So in the sense, I mean, so it doesn't belong in this table taxonomy of money because it's not money, But I just wanted to make you kind of use these criteria to understand what this. But there was another person. Yeah.
Yeah, I mean, nobody's like having it's liable for it. So, I mean, a non-fungible token is only that worth what you think is worth. So, it could be very valuable to you, but for someone else, it could like not valuable at all. So,
Yeah.
in money, it's different. I mean, one euro is €1 worth.
Yeah.
Nevertheless, what I think or what you think, because someone else accept the euro to
Yeah.
give me something else. But with the
Yeah.
non-fungible token, I mean,
Yeah.
somebody is thinking a painting is worth, I don't know, millions of dollars, but somebody else thinks, no, that's not art, so I wouldn't pay anything for it.
Yeah. No, I agree. I agree with you. Yeah. So I would say we will agree that there would be no issuer in this case. So the issuer would be nobody. What is the form? That's easy. Yeah. Digital. Access. How would you say? Universal, limited? How would you call this? Yeah.
I would say limited because you need the blockchain to access it, or it's sort of
Yeah.
blockchain.
Exactly. So similar to Bitcoin. So it's you need some technology to access it. Exactly. And transfer system is also quite easy. Is what? Any idea? How is it transferred? Yeah.
Decentralized.
Mostly decentralized, I would say. It's on a blockchain or yeah. Okay. Any other question on NFT? Again, I'm not an expert of it. I'm just because for me it's not a form of money as was mentioned rightly. So. Okay. So now let's have a look a bit at banks. So all these. So the question of all these different forms of money is, can be seen against the reality, the current reality that actually, so the bank deposits are the center of the monetary system. So most of us use eventually bank deposits when doing payments, as a form of money. So the bulk of current monetary aggregates are made out of different types, maybe of bank deposits. And so we know, and this we already mentioned in past lectures, that banks have a function. So they have this maturity transformation. They have basically liquid liabilities, illiquid assets, and they have other functions. They are able to monitor loans. So basically they lend. They are good in lending. They are good technology in lending, both based on IT but also soft information. So loan officers knowing the people they lend money to. And so there is a huge literature on banks, of course, and basically one kind of conclusion on this literature is that banks are efficient. So this combination of deposits and loans is very efficient, but it's also fragile. So there is a risk of runs. There is a risk that basically depositors want the money back. So banks have to reduce bank deposits abruptly, and then they have to sell their assets very quickly at a discount. So this creates a bank run. So I hope you have already done this in other courses, but it's the essential of bank run. So the banks are efficient but fragile. Okay. I mean, I don't know how much you know about this. There is a huge literature on that, but essentially it tells you that the current system is based on this combination of deposits and loans. And this combination again is, there are synergies between the two functions, but also there's a risk that in a crisis period, all this system collapses. And so you have a banking crisis, and banks have to contract very quickly both deposits and loans. Okay. So can somebody tell me one historical example of bank runs, a period when there were bank runs?
The Great Recession?
Yeah. Although it started in the non-bank sector, but yeah. Any bank that you know that had a run or?
Norfolk was the New York one in 2008.
Yeah, exactly. It was this this bank in UK also, and also others. Yeah. Yeah.
During the euro crisis in Greece.
Yeah, that is even more clear. 'Cause I agree, because in 2015 in particular, there was a big contraction of deposit to the extent that Greece had to impose capital controls, so you cannot convert deposit into cash. So there was a limit in how much euro cash you can convert your deposit into. So that was another example. I mean, another big example is the Great Depression in the 1930s. So there was a wave of bank failures and bank runs. It's called run because initially people actually run. So it's a physical, so people ran to the bank to get the money, because the problem was that those who came first, they could get the money back, but those who came late, they had more difficulty in getting the money back. So this means that, you know, it was really a physical running. So there are images from the Great Depression of really crowd, you know, pushing in the bank branches and try to get the money out. Yeah. Okay, so banks are efficient but fragile, but our current system is based on what is called fractional reserve banking. So what is fractional reserve banking? Have you heard this concept? Yeah.
The banks only need to hold a small percentage of deposits to lend a bigger amount of money.
Say it again. I mean,
You only need to hold, let's say, 20% or 10% of a deposit in order to lend.
In which form? In which form? So.
In like liquid cash.
Yeah, exactly. So basically, so I mean, oversimplifying, the balance sheet of a bank is the following. So you have basically deposits on the liability side, and then on the asset side you have loans and reserves. Okay, so, and you know, in theory, because people can immediately get the money back, you could hold basically reserves against deposits. Okay, so you can have 100% coverage. But because you know that not everybody will withdraw their deposit at the same time, you can only, so by diversifying basically, so you can hold only a small fraction of the reserves against your deposits. So you can have 100 of deposit on the liability side, but on the asset side you can have only 10 of reserves. Okay, so you can kind of play on this lack coordination by depositors who withdraw their money. Of course, this happens in normal times, but then you have the fragility in the sense that in a crisis, when everybody wants the money back, then the bank doesn't have enough reserves to finance this withdrawal of deposits. But what is the advantage of this is that the bank can also lend to the real economy, and so this holding of reserves is inefficient. So it makes the bank safe, but also inefficient. While the fractional reserve banking means that reserves are less than 100%, and so this creates this efficiency against the cost of runs. So that's the notion which is here, that basically narrow banking means that you are basically, you back your deposits entirely with reserves, so with safe liquid assets, is inefficient but safer. So it's the opposite of fractional reserve banking. Okay, so inefficient but safe. And I mean, there is, as I said, a huge literature saying that there are economies of scope and scale between deposits and loans. So those who have, so the institutions that issue deposits are well placed also to make loans. Yeah.
So basically what narrow banking is that banks have to have reserves in order to, or they can't lend all of their deposits to anyone, and that makes the banking system narrow.
Yeah, so narrow exactly means that you basically, that you have deposit on the liability side and reserves. So safe assets on the asset side, you can't do any loans, risky loans. You cannot, or you cannot have risky assets basically on the asset side, and that is so it's very safe, but not very, it's kind of socially efficient. So the credit provision suffers, etc. Yeah. So here, just to say that okay, this is the current system. So shifting to a system where money is made out of non-bank liabilities would be a fundamental change in the current system. because as I will argue next week, stable coins, if you think of Libra, was essentially a form of narrow banking. Okay, so if something like Libra took over or takes over, we may move to a system which is largely narrow banking, and it would basically undermine the current system based on fractional reserve banking. So it would be so if that happens, I don't think will happen necessarily, but if that happens, will be a fundamental change in the financial system. So that's probably the most kind of crucial fundamental question. Yeah.
But are all stablecoins completely backed by security?
Yeah, that's a good question. So
At the moment, that's exactly the problem, right?
yeah, so it's interesting. It's interesting that there is a bit of a crash in crypto going on right now, and as we will see next week, some stable coins like Tether are also used to trade in cryptos, and it's also falling in value. So Tether, as we will discuss next week, is convertible 1-to-1 into US dollars, but this parity has been broken. So actually, they trade below 1. So I think they trade at 90 something. So yeah. So but there is it's interesting right now. There is a bit of a small crash of cryptocurrencies. So I don't know if some of you have invested. It may not be nice, but these are risk investments. So okay, other questions? Okay, other important aspects to consider. Okay, so one element which is always there in these discussions on monies, is the legal tender. So you know what the legal tender means? A legal tender of a currency? Anybody can make an example? Yeah?
That you're allowed to use the money, for example, for taxation.
Yes, and partly, but not only. Yes, partly that is that. Other definitions? So if I go, yeah?
I think everybody has to accept the euro.
Yeah, exactly. It's more this,
Because
yeah.
it's a legal tender, but you don't have to accept like any other money. So if you go to supermarkets, you don't have to accept bitcoins, but the supermarket has to accept euro.
Yeah, no, it's exactly. I would say the legal tender is more this. Now, of course, it may, one consequence of this is also, as you said, also the tax payments. So I agree that this is an important part. I think also I already argued that accepting tax payments in a certain currency is a big boost to the role of that currency in a certain jurisdiction. But I think the proper definition is yours. Is basically that basically economic agents have to accept that currency as a form of payment. It looks simple, but actually in actual practice is not clear, because the acceptance. I think I don't know much in terms of jurisprudence, but I think you can't always force people to accept payments. So I think there was a case, for example, in Sweden, whether shops are forced to accept physical cash, in cases where they largely move to digital payments. So are they really used are they really forced to accept physical krona, even if they actually only offer digital payments? So it's not clear exactly what the law really implies, and in particular if it is enforced. So the legal tender is a slippery, and it depends, of course, entirely on the state capacity. So the efficiency of the state to implement, of course, laws. So one example, Bitcoin is a legal tender in El Salvador, but we know that almost nobody accepts Bitcoin as payment over there. So even though it is legal tender, it's actually rather a moot point. So it's not really doesn't imply that it's widely used for transactions. Okay, so of course El Salvador is probably not the most stable country in the world, but even in advanced economy, it's not really clear how much you can force people to accept payments. So it's a bit of a slippery, and I think in the context of digital currencies, this discussion is also there. So what exactly do we mean by legal tender? And there are also legal cases. There is also a legal case in Germany, which I don't know much about, but there is a litigation whether euro banknotes have to be accepted necessarily or not. Yeah. I mean, a further complication of legal tender in Europe is that the legal tender laws are national, but the currencies are supranational. So the laws are, so whether the euro is accepted and how is a national law, but the euro, of course, is issued at the European level. So that's an additional also complication. Okay, then the other question that is interesting is also, okay, what underpins the value? What underpins the value of a certain digital currency? No, because in the end, you exchange, you transact on things that have some value. Okay, so what gives value to this different forms of money? And so here, so you can take this a bit as an exercise. So I would say these are the four possible ways in which value can be created. You can pick any of these currencies and think yourself, what gives value. Perhaps we can try a couple of them now. So basically, a form of money can have some intrinsic value. So you can have a bullion of gold have some value because the gold is useful. Okay, so a commodity can be useful, or cigarettes sometimes in history, etc. Then basically you can have which is probably the most common situation, where you have a network externality. So other people use this form of money as payment. And these normally, so this by itself can give value to a certain form of money. So if everybody else uses it, gives value to this form of money, then it acquires some value, even if it is intrinsically worthless. And this is typically also interplays with some form of limited supply. So if this form of money can be issued in an infinite way, then this normally tends to drive the value to zero, okay? Because then you can issue an infinite amount. But if you have some restriction to supply, and you have some form of network externality where a sufficient large amount of users believe that there is a value in this form of money, then by itself, only by itself, you can have a situation where this form of money has value. So it's not true that something must have some own or intrinsic value to have actually real value in transactions. So it can also have some simply social value deriving from the fact that everybody else is using them. So the network externality argument. An additional kind of idea, which is a bit related but also slightly different, is that basically there is a bubble. So the price of an asset is driven by the expectation of future price increases. Okay, so you believe, and the market believes, even in some unpredictable way if you want, but it believes that the price will go up. So if you believe that the future price will go up, even if the form of money or the digital asset is by itself worthless, if there is a kind of critical mass of investors believe the price will go up, then the price today will also go up or will be positive. Okay, so this is a typical bubble behavior. We discussed about rational bubbles. Okay, so this is another issue, and then there is a fourth, which is the fourth source of value, which has been also mentioned several times with reference to Bitcoin. Is that even in respect, so even abstracted from these two, in a completely rational way, if you have an asset that has low correlation with other assets, that by itself gives some value to that investment. So you know that when you want to diversify your portfolio, what you want to look at for something that has low correlation with other assets. That's the principle of diversification. Okay, so you want something that is not correlated with the rest. And if something has low correlation, this is valued more, so the price goes up, no? Because basically you want to hold that asset even if this asset has a expected negative return, because it's negatively correlated with other assets. So that's really the ABC of portfolio diversification. So the argument goes that if crypto or if Bitcoin has very low correlation with other risk investments, so for example with the stock market or with the dollar exchange rate, and so etc., then by itself, crypto has some intrinsic value which just derives by this low correlation with other assets. So even abstracting from the fact that other people use it, etc. So if this factor is important enough, then you can have a basically positive value, which then can be used to underpin. So can be used to underpin then transactions carried out in that form of money, because that form of money has some positive value. Is it kind of clear that how these kind of four sources of value how they are defined and they're different? So, for example, here we could make, for example, in the case of let's start with I don't know, physical cash. So physical cash, I mean, does it have intrinsic value? No. So I mean, the banknote can be beautiful, but it doesn't give you any service. Net externalities versus limited supply. Yeah.
Definitely network externalities.
It has, huh?
It has network externalities because everyone uses it.
Yeah, so that's exactly, it's a positive, is an export externality, exactly. So everybody else uses it, and okay, is there a limited supply? I would say yes, but not always. Of course, in advanced economies, yes. I mean, the central bank limits the supply. That is what monetary policy is. No? So monetary policy is about that. So there is a limited supply, but you have many examples in history where this kind of power or creation of money has been abused, and you have hyperinflation. Okay, so in the hyperinflation countries, the constraint on limited supply is foregone, and therefore the value can plummet to zero. I mean, in the Zimbabwe dollar was used as toilet paper. Okay, so you can have cases where it really goes to zero. Does cash have has any bubble value? Yeah.
I would say actually the opposite of it, because we believe we have inflation, so we believe that the money will become not worthless, but a little bit less.
Mm-hmm. So okay, so you say okay, yeah.
But if we have
Yeah.
we don't have inflation, then maybe yes.
Yeah, okay, so yeah, in that sense you're right, but of course one can also argue that the price of cash is fixed at 1, no? So it is what defines the price level. So in a sense, in nominal terms, I would say it can never be a bubble value, because the price level is defined in terms of the cash banknote. Is what defines the price level in euro, no? In nominal terms. I would say that is excluded for cash. Investment value, low correlation with other assets. I mean, we know that a surprising number of people actually hold cash as investment. So I know that a significant chunk of cash is actually savings, which could be seen as surprising, but so I wouldn't completely dismiss the low correlation story, in the sense that maybe some individuals, maybe not the most sophisticated ones, they believe that cash is maybe a good investment in crisis times. So in that sense, is a hedge in crisis times. So if everything collapses, if you hold some cash in the mattress, that may be worthwhile, but it's not, certainly not a major component. Okay, let me pick then for example, Bitcoin. I mean, Bitcoin we have not really looked at. Let me check. What can we pick? Let's pick bank deposits. So bank deposits, do they have intrinsic value? No intrinsic value. Maybe it's a digital asset. Net externality versus limited supply. I mean, remember, what is a bank deposit? What is essentially a bank deposit? No, it's basically a right to have a cash banknote. So I would say whatever holds for cash, holds almost automatically for bank deposits, with the additional probably complexity that this conversion is not always guaranteed. You can have a banking crisis, but essentially a bank deposit is a form of cash, just held in digital form. So I would say the second is really the biggest source of value. And again, investment value, maybe yes, to some extent. Again, many investors hold bank deposits for safety reasons. So I don't think it necessarily is a hedge, but certainly they are held as safe investments. Maybe let me try with Bitcoin. Although again we go into more detail on Bitcoin in 2 weeks' time. So does Bitcoin have intrinsic value? No, it's just a string of numbers and letters. Net externalities versus limited supply. So do you know if Bitcoin has a limited supply?
I mean, it's limited because you cannot do as many transactions with Bitcoin as you can do with cash. I mean, I can give cash to anyone, but Bitcoin is limited.
Yeah.
Limited to the supply in the sense that you need exponentially more computing power to mine them at some point.
Yeah. So actually, there is a long-run limit to supply. I think it's 21 million Bitcoin. So there is the system is designed so that when the number of Bitcoin around increases, the computing power necessary to mine it goes up. So it becomes infinite when the number of Bitcoins approach, I think it's 21 million. So it's one of the beauties of the Bitcoin system is that there is this limited supply. Okay, net externalities. Probably they matter for Bitcoin because people believe in the value. Bubble value. No, probably relevant for Bitcoin because of course the price it swings very, I mean both up and down. So it's really a big part. Low correlation with other assets. Is it relevant for Bitcoin? What do you think?
No.
No? Why not?
Because, I mean, some people said so, but in latest times they have seen that the correlation with Nasdaq, for instance, is really high.
Yeah. It is not. Yeah.
It wouldn't be like a protection against the stock market at least.
No, exactly. I would also say the same. So traditionally, this has been one of the reasons why Bitcoin has been suggested as part of the portfolio. So people say, okay, even if you don't hold a lot, if you hold 3% of your portfolio, say for example, in Bitcoin, it gives some diversification benefits because it tended to be very uncorrelated with other key financial prices. But what we've seen increasingly is that it's more and more correlated with the rest of the market, and we have seen that already also now. So the fall in crypto we are seeing now is also in the context of a general kind of market tension because of the war, etc. So now is an example when crypto is not providing a diversification really. But I mean, we cannot exclude that in the future will again be less correlated, or even as somebody will design a new crypto with these features. So we could say, okay, somebody smart comes up with an idea to create a crypto that has, by design, low correlation with other assets. Then maybe that crypto would be valuable for that reason. So but you have to design it that way. I think the interesting part of all these phenomena is that can be designed. So new coins can be introduced. So they can be invented. So if somebody is innovative enough, you can take these aspects into account and actually build a better crypto on these characteristics. Okay. Perhaps the last try. What about gold? So gold, does gold has intrinsic value? Yes. Need a supply? Yes. I mean, gold is difficult to extract. So I would say that in case of gold, both these aspects actually matter. So it's not only the intrinsic value, but we have seen that the value of gold as a means of payment, gives additional value to this metal. So it's not only the intrinsic value. It's not only the fact that gold can be used in, I don't know, industry or whatever, but it's actually also that that it also has a monetary role vis-a-vis the difficulty in extracting gold from mines. Yeah.
Yeah, I wanted to ask a question that goes in the same direction. I think the intrinsic value with gold is a bit of an odd case since it essentially depends on the belief that gold is valuable. I believe that there is limited applicability or use for gold in the actual real economy.
That I'm not sure. I mean, of course, it can be used in jewelry and so on. But of course, you can also argue that even the jewelry itself is just a convention, because why? So is gold intrinsically beautiful or not? I mean, maybe we see it beautiful because we are used to think that it's beautiful. That's why we have jewelry in gold. But I'm not sure if really is extrinsically beautiful, or just we believe it's beautiful because everybody uses gold and thinks that gold is valuable. So it's a difficult discussion to have. I personally find sometimes gold is even beautiful. So it has this intrinsic value in that sense, in terms of beauty. But it's not necessarily. I mean, there is a church in Sicily, in Italy, which is entirely gold. So you enter the church, and all the walls and the roof is entirely covered with gold, and it's super impressive. I found. So in some cases, I find gold super. But I agree with you that maybe this intrinsic value is not really the key, probably. So it's a secondary aspect. So this network analysis, the fact that people actually use gold, is probably primary, I would say. So on that I agree. Yep.
Maybe it's also a good storage item because you have something which is kind of good to make coins out of, or you can store it relatively easily.
Yeah, exactly. You can store a lot of value in a bullion. I mean, the bullion the bullion gold is a bit like this, and I think it's worth like maybe €500,000. So you can actually hold €500,000 in a object which is this size. Although, of course, you can also argue that this can also be stolen. And actually, gold is also very heavy because I actually held a bullion in my hand in Prague, in the Museum of the Czech National Bank, and it's extremely heavy. So much more than iron or other metals. Yeah. Was any other question on gold or views? Yeah, again on the kind of more industrial use of gold, I'm not sure. Maybe I agree that this is not probably a biggest. So the metal with the biggest use maybe is more like using jewelry or for aesthetic reasons. Bubble value, I would say maybe not so much. Low correlation with other assets. I mean, people say that gold is a good hedge. So it's considered to be a safe asset.
It's negatively correlated normally to the stock market.
Yeah. So gold has some value as a hedge. So in the sense, it also derives. So I would say it derives from the three of them, not the bubble, but investment value. Okay, I think you get the logic of this small exercise, but you can have fun with any. And again, I mean, in terms of money, you can also easily think about monies that don't exist yet. No, so it's. So an exercise you could do is also what kind of money would you design, based on these characteristics. No? So what would you do? No? So what is the ideal form of money? Or that's it, I think. So I had so the Beck and Garrett is the paper with the classification with the criteria. The second paper I also find useful, and the third is interesting mostly for The third is a longer survey paper, and is useful mainly for the discussion on what underpins value, what creates value, but it has many other things. So if you, I would say, if you want to read only one of them, I would pick the first, maybe. But of course, the more you read, the better. So, basically, as I said, I mean, the plan is the rest, you know, of the next lectures is that we go in this order. So basically, stable coins next week. Remember, in Zoom. Then in 2 weeks' time, we talk about crypto and Bitcoin. I mean, we may spend 2 lectures here because it's a bit more complicated. And then I will have at least a lecture on CBDC. And then there will be 2 other lectures. So one on the international dimension, so national versus international aspects. And there will be also a lecture on regulation. So the question will be, do we regulate? So do we need to regulate those things? You know? So how does a policymaker, how should the policymaker see these things, and should we prevent these private monies from arising, from taking over, or should we allow it? Why? What is the reason? So there will be a lecture on regulation of those things. But first, we will basically go through this both in turn. So starting from stable coins. Any further question? So don't buy or sell your crypto yet before knowing all these details. You can do it later. Okay, then we can see each other probably online next week. Okay. Yeah.